Picture this scenario. You're scrolling through your phone at 2 a.m., unable to sleep, and suddenly you start doing that thing we all do. You open your banking app and stare at your account balance, and your stomach drops. Not because the number is necessarily bad, but because you realize you have absolutely no idea if it's enough. Enough for what, you ask? Enough for life to happen. Because life has this funny way of throwing curveballs when you least expect them, and most people are standing in the batter's box completely unprepared. Your washing machine decides to flood your apartment on the same day your car starts making that expensive grinding noise. Your company announces layoffs right after you've finally gotten comfortable with your monthly expenses. Your dog needs emergency surgery during the week you were supposed to pay rent. Sound familiar? These aren't hypothetical disasters that happen to other people. These are Tuesday afternoon realities that millions of Americans face every single month. And the difference between financial survival and complete catastrophe often comes down to one simple question. How much money do you have sitting in a savings account that you've promised yourself you'll never touch unless the world is literally falling apart? My name is Alex, and I've spent the better part of a decade helping people figure out their relationship with money. Not the sexy, get-rich-quick kind of money advice that fills up your social media feeds, but the boring, unglamorous, absolutely essential foundation that determines whether you sleep soundly at night or lie awake calculating how many meals you can skip if your paycheck is late. If you're someone who wants to understand the real mechanics of financial security, instead of just hoping everything works out somehow, make sure to hit that subscribe button and give this video a thumbs up if it ends up helping you build a safety net that actually makes sense for your life. Now, before we dive into the specific numbers and rules that can transform your financial anxiety into genuine peace of mind, let me ask you something that might make you uncomfortable. When was the last time you calculated how long you could survive without your current income? Not survive comfortably, not maintain your current lifestyle, but literally keep a roof over your head and food in your stomach if your primary source of money disappeared tomorrow. Most people have never done this calculation, and honestly, that's terrifying. Because without knowing your survival timeline, every emergency fund recommendation you've ever heard is basically meaningless advice. Here's what I'm going to do in this video. I'm going to walk you through the exact framework that financial planners use to determine emergency fund targets, but more importantly, I'm going to show you how to customize these rules for your specific situation. Because the truth is, the person working a stable government job with excellent health insurance needs a very different emergency fund than someone who's freelancing with 3 different income streams and no benefits. The single person living in a studio apartment has different requirements than the parent of 2 kids with a mortgage and a minivan payment. Yet somehow, most financial advice treats everyone like they're living identical lives with identical risks. We're going to start by breaking down the psychology behind why emergency funds work, because understanding the why makes the how much more powerful. Then we'll dig into the mathematical framework that determines your personal target number. After that, I'll show you the strategic approach to actually building this fund without deriving yourself of everything enjoyable in life. And finally, we'll talk about the advanced rules that separate people who are truly financially secure from those who just think they are. But first, let's address the elephant in the room that nobody wants to talk about. Most Americans are living one unexpected expense away from financial disaster, and they have no idea how precarious their situation really is. According to recent Federal Reserve data, nearly 40% of Americans couldn't cover a $400 emergency expense without borrowing money or selling something they own. $400. That's less than most people spend on their monthly car payment, yet it represents a financial crisis for almost half the population. This isn't about people being irresponsible or making bad choices. This is about a fundamental misunderstanding of how money actually works in the real world. We're taught to think about budgeting in terms of monthly income and monthly expenses, as if life operates on a predictable schedule where problems only arise when it's convenient. But that's not how emergencies work. They don't wait for your next paycheck. They don't care if you've already allocated every dollar for the month. They show up uninvited and demand immediate payment. And if you can't provide that payment, they multiply into bigger, more expensive problems. Think about the last major unexpected expense you faced. Maybe your phone screen cracked and you needed it for work. Maybe your kid got sick and you had to take unpaid time off. Maybe your apartment's heat stopped working in the middle of winter. Now, think about how that situation would have been different if you had a dedicated pile of money sitting in an account specifically designated for exactly that type of problem. Not money that was supposed to go toward rent or groceries or your credit card payment, but money that existed solely to handle life's inevitable surprises. This is where most people get emergency funds completely wrong. They think of them as something nice to have, like a luxury feature on a car that you can skip if you're trying to save money. But emergency funds aren't luxuries. They're financial insurance policies that you pay yourself instead of paying to some massive corporation. And just like any insurance policy, the question isn't whether you need one. The question is how much coverage makes sense for your specific situation. The traditional advice you've probably heard is to save 3 to 6 months of expenses. This recommendation gets thrown around so casually that most people accept it without questioning where it comes from or whether it applies to their circumstances. But here's the thing about rules of thumb. They're designed to be simple enough for anyone to remember and apply, which means they're often too general to be truly useful for your specific situation. Let me give you an example of why the standard advice falls short. Imagine two people who both have monthly expenses of $3,000. Person A is a tenured professor with excellent health insurance, a pension plan, and job security that's practically guaranteed. Person B is a freelance graphic designer with irregular income, no benefits, and clients who sometimes pay late. According to traditional advice, both of people should have the same emergency fund target, somewhere between $9,000 and $18,000. Does that make sense to you? Obviously not. Person B faces significantly more financial uncertainty and should probably have a larger emergency fund relative to their expenses. But the standard advice doesn't account for these differences because it's trying to be one-size-fits-all guidance in a world where financial situations are incredibly diverse. This is exactly why we need a more sophisticated approach to emergency fund planning. An approach that considers your specific income stability, your insurance coverage, your family situation, your debt obligations, and your access to other resources during a crisis. Because when you customize your emergency fund target based on your actual risk factors, something magical happens. You stop feeling like you're either saving too little and living in constant anxiety, or saving too much and missing out on other financial goals. The framework I'm about to show you takes into account all of these variables and gives you a personalized target that actually makes sense for your life. But before we get into the specific calculations, we need to understand the different types of emergencies that your fund needs to cover, because not all financial surprises are created equal. There are essentially 3 categories of financial emergencies that most people face, and understanding these categories is crucial for determining how much you actually need to save. The first category is what I call maintenance emergencies. These are the predictable unpredictables. Your car needs new brakes. Your laptop dies right before a big project deadline. Your air conditioning unit decides to give up during the hottest week of summer. These expenses typically range from a few hundred to a couple $1,000s, and while you can't predict exactly when they'll happen, you can be pretty certain they will happen eventually. The second category is income disruption emergencies. This is where things get serious. Job loss, medical leave, business downturns, industry changes that affect your earning potential. These situations don't just require you to pay for something unexpected. They cut off or reduce your ability to generate your income while expenses continue rolling along like nothing happened. This is where that traditional 3 to 6 months of expenses calculation starts to make more sense. But even here, the standard advice misses some critical nuances. The third category is what I call compound emergencies, and these are the ones that can completely derail your financial life if you're not prepared. This is when multiple problems hit simultaneously, or when one problem creates a cascade of additional problems. You lose your job, and then your health insurance, and then you get sick. Your car breaks down, which makes it harder to get to work, which affects your income, which makes it harder to pay for the car repair. These scenarios are where having a robust emergency fund transforms from being financially convenient to being financially life-saving. Now, here's where most financial advice completely fails you. It treats all three categories as if they require the same type of preparation, when in reality, they require completely different strategies. Maintenance emergencies need quick access to cash, but relatively small amounts. Income disruption emergencies need larger amounts, but you have more time to access them gradually. Compound emergencies need both substantial amounts and immediate availability, plus the flexibility to handle multiple problems at once. This is why the cookie-cutter approach to emergency funds sets so many people up for failure. They save some arbitrary amount based on a general rule, and then, when a real emergency hits, they discover that their preparation doesn't match the reality of their situation. They either don't have enough money, or they have money but it's not accessible when they need it, or they have accessible money, but it's not enough to handle the full scope of their problem. So let's talk about how to build an emergency fund that actually works for your specific circumstances. The first step is conducting what I call a vulnerability audit. This sounds fancy, but it's really just an honest assessment of where your finances are most likely to break down. Start by looking at your income stability. Are you a W-2 employee with a predictable salary, or do you have variable income that fluctuates month to month? Do you work in an industry that's prone to layoffs or economic downturns? Do you have multiple income sources, or does everything depend on one job or one client? Next, evaluate your expense flexibility. How much of your monthly spending is absolutely non-negotiable, and how much could you realistically cut if you had to? Your mortgage payment is probably non-negotiable. Your subscription to 17 different streaming services probably isn't. The person who could cut their expenses by 50% if necessary needs a smaller emergency fund than someone whose expenses are mostly fixed obligations they can't easily reduce. Then consider your support network. This isn't just about whether your parents could loan you money in a crisis, though that's certainly relevant. It's about understanding all the resources you could potentially access during an emergency. Do you have family members who could provide temporary housing if you lost your apartment? Do you have professional connections who about job might know opportunities if you lost your current position? Do you have skills that could generate income quickly if your primary source disappeared? Your insurance coverage plays a huge role in determining your emergency fund needs, and this is something most people completely overlook. If you have comprehensive health insurance with low deductibles, your medical emergency fund needs are very different from someone with a high deductible plan or no coverage at all. If you have disability insurance that would replace a significant portion of your income, you might need less cash on hand for income disruption scenarios. Here's something that might surprise you about emergency fund planning. The goal isn't necessarily to have enough money to maintain your exact current lifestyle indefinitely. The goal is to have enough money to maintain your essential lifestyle while you solve whatever problem caused the emergency in the first place. This distinction is crucial because it prevents you from oversaving for scenarios that are unlikely to last very long. Let me give you a practical example of how this works. Sarah is a marketing manager earning $65,000 per year with monthly expenses of $4,200. Traditional advice would tell her to save between $12,600 and $25,200 for emergencies. But let's dig deeper into her specific situation. She works for a stable company in a growing industry, has excellent health insurance, and could reduce her expenses to about $2,800 per month, if necessary, by cutting discretionary spending and temporarily moving in with her sister. Given these factors, Sarah's actual emergency fund needs are probably closer to the lower end of that range, focused primarily on covering maintenance emergencies and providing a few months of essential expenses if she needed to find a new job. She doesn't need to prepare for a worst-case scenario where she maintains her full $4,200 monthly spending for 6 months without any income. because that's not how her emergency would likely play out in reality. Contrast that with Mike, who's a freelance consultant with irregular income, minimal health insurance, and fixed expenses that are difficult to reduce because he supports elderly parents. Even though Mike's monthly expenses might be similar to Sarah's, his emergency fund needs are substantially different because his risk profile is completely different. This personalized approach to emergency fund planning does something that generic advice can't do. It gives you confidence that you're prepared for your actual life, not some theoretical average person's life. When you know you've thought through your specific vulnerabilities and planned accordingly, you can stop lying awake at night wondering if you're doing enough. You can also stop feeling guilty about not having some arbitrary amount saved, because you understand exactly why your target makes sense for your situation. But building an emergency fund that actually works requires more than just picking the right target amount. It requires understanding the psychology and logistics of how to accumulate that money without making your current life miserable, and how to maintain that fund over time without constantly dipping into it for non-emergencies. Because here's the thing about emergency funds that nobody talks about. The hardest part isn't figuring out how much you need. The hardest part is actually saving it and then leaving it alone. Most people approach building an emergency fund like they approach New Year's resolutions. They get motivated, make dramatic changes to their spending habits, save aggressively for a few weeks or months, and then burn out completely when the initial enthusiasm wears off. They treat it like a sprint when it's actually a marathon, and that fundamental misunderstanding is why so many people never build the financial safety net they desperately need. Here's what actually works. You start ridiculously small and focus on consistency rather than speed. I'm talking about amounts so small they almost feel embarrassing. $25 per week, $50 per month. Whatever number makes you think that's it, that won't make any difference, because that's exactly the point. You're not trying to build your entire emergency fund in the next 6 months. You're trying to develop the identity and habits of someone who saves money for emergencies. The psychology behind this approach is fascinating, incredibly powerful. When you start in small amounts, you're essentially training that your brain to recognize can live comfortably while setting money aside. You're proving to yourself that saving doesn't have to mean deprivation or sacrifice. This mental shift is crucial because most people have a subconscious belief that saving money requires giving up things they enjoy, and that belief makes long-term saving impossible. But when you start small enough that the amount doesn't affect your daily life, something interesting happens. Your brain stops fighting the process. Instead of feeling like you're constantly choosing between saving money and enjoying life, you begin to see saving as just another automatic part of your financial routine, like paying your phone bill or buying groceries. The key is to make your initial emergency fund contributions so automatic and so small that you forget they're happening. Set up a transfer that moves money from your checking account to a separate savings account on the same day your paycheck arrives. Make it happen before you have time to think about it or spend money on something else. This isn't about willpower or discipline. It's about creating systems that work regardless of how motivated you feel on any particular day. Once you've established this baseline habit, you can gradually increase the amount without it feeling like a dramatic lifestyle after change. Maybe 3 months of saving $25 per week. You bump it up to $35 per week. After another few months, maybe it becomes $50 per week. The beauty of this approach is that each increase feels manageable because you've already proven you can live comfortably while saving the previous amount. There's another psychological factor that makes this gradual approach incredibly effective. As your emergency fund balance grows, you start to experience what financial psychologists call the wealth effect. Seeing money accumulate in your savings account creates a positive feedback loop that actually motivates you to save more. You begin to take pride in watching that number each increase month. You start looking for additional ways to boost your contributions because the progress becomes genuinely exciting. This is completely different from the emotional experience of trying to save large amounts immediately. When you attempt to save aggressively from the beginning every contribution feels like a sacrifice. You're constantly aware of what you're giving up in order to build your emergency fund. But when you start small and gradually increase, each contribution starts to feel like an investment in your future security rather than a loss of current enjoyment. Now, let's talk about where to actually keep this money, because this decision is more important than most people realize. The fundamental requirement for emergency fund money is that it needs to be immediately accessible when you need it, but not so accessible that you're tempted to spend it on non-emergencies. This creates what seems like a contradiction, but there are several strategies that solve this problem elegantly. The classic solution is a high-yield savings account at an online bank. These accounts typically offer better interest rates than traditional brick-and-mortar banks, but the money isn't quite as easy to access as your regular checking account. You can transfer funds electronically, but it might take a day or two for the money to become available in your checking account. This slight friction is actually beneficial because it prevents impulse spending while still allowing relatively quick access during genuine emergencies. Some people prefer to keep their emergency fund in a money market account, which often provides slightly higher interest rates and may come with limited check writing privileges. Others use certificates of deposit with short terms, like 3 or 6 months, and ladder them so that some portion of their emergency fund becomes available every few months. The specific vehicle matters less than ensuring the money earns at least some return, while remaining accessible when needed. Here's something most people get wrong about emergency fund storage. They think earning the highest possible return should be the primary consideration, so they invest their emergency fund money in stocks or bonds or other investments that might lose value when they need the money most. This completely defeats the purpose of having an emergency fund in the first place. The goal isn't to maximize returns. The goal is to have money available when everything else in your financial life is falling apart. Remember, emergencies have a funny way of coinciding with economic downturns. You're more likely to lose your job during a recession when the stock market is also declining. Your business is more likely to struggle during periods when your investment accounts are also losing value. If your emergency fund is invested in assets that fluctuate with market conditions, you might find yourself in the devastating position of needing to sell investments at a loss precisely when you can least afford to do so. This is why financial security requires boring investments for your emergency fund. You want the money to maintain its value and be available regardless of what's happening in the broader economy or financial markets. Think of your emergency fund as insurance, not as an investment opportunity. You're paying a small opportunity cost in terms of potentially higher returns in exchange for the certainty that the money will be there when you need it. But here's where emergency fund strategy gets more sophisticated. Once you've built your basic emergency fund, you might consider what's called a tiered approach. This means keeping your most immediate emergency money in the most accessible accounts, while keeping additional emergency funds in slightly less accessible but yield-higher options. For example, you might keep 1 month of expenses in a regular savings account that you can access instantly. Then, keep the next 2 months of expenses in a high-yield online savings account that takes a day or two to access. Any additional emergency money beyond that could go into short-term certificates of deposit or treasury bills that offer better returns, but take slightly longer to convert to cash. This tiered strategy recognizes that different types of emergencies have different timing requirements. If your car breaks down and you need to pay for repairs immediately, you need cash today. But if you lose your job, you have a few days to move money around while you figure out your next steps. The tiered approach optimizes for both scenarios without sacrificing too much return on the money you're less likely to need immediately. There's also the question of whether to keep some physical cash as part of your emergency preparation. This might sound old-fashioned in our increasingly digital world, but there are scenarios where electronic access to your money might be temporarily unavailable. Natural disasters can knock out power and internet connectivity. Banking system outages can prevent electronic transactions. Having a small amount of physical cash on hand, maybe a few $100s, provides an additional layer of security for these extreme situations. The amount of physical cash that makes sense depends partly on where you live and what types of emergencies are most likely in your area. Someone living in a region prone to hurricanes or earthquakes might want to keep more cash on hand than someone in a more stable area. But remember, cash doesn't earn any return and can be lost or stolen, so this should be a relatively small portion of your overall emergency fund. Building an emergency fund isn't just about accumulating money in a savings account. It's about transforming your relationship with uncertainty and giving yourself the gift of financial breathing room. When you customize your emergency fund based on your actual risks rather than generic advice, you create something more valuable than just a pile of cash. You create peace of mind that lets you sleep soundly, knowing you're prepared for whatever life throws your way.